What happens when we have an employee that works in more than one state? So, and we'll talk more about this as well in the next chapter because it's relevant with regard to state unemployment tax. When we were talking about local tax, now at the federal level it's not really a problem, right? Because federal taxes apply to you regardless of where you work within the US. But maybe you live in Davenport and you have an office in Davenport, and then you have an office in, what's across the road? Rock Island? I don't know, Illinois. You're working in two different states, right? Both states could tax you on the income that you are earning. Now there are many states that are like that, like Iowa and Illinois, or Iowa and I think Nebraska as well, have these reciprocity agreements where the states will withhold tax depending upon where the employee lives full time. They'll have to manage that between the two states. So there is this issue of reciprocity between states, but it could be that an employee is, or maybe they live in Iowa, but they work in Illinois. So now they're filing their taxes in Iowa. They may also have to file taxes in Illinois. There is, when that occurs, it's really on the employee to determine how they're going to file those tax returns, but they may have to file in both locations and then apply a tax credit to those amounts. Get a credit for the taxes paid in the other jurisdiction. But most states, a lot of states, especially where you've got a lot of employees working cross-state, will have these reciprocity agreements. What else did I want to say about that? That was just something I wanted to mention. It is in your book. I think it's covered a lot more in your book than in the slides, and I know I didn't really cover it very much. Let me see if the book has anything extra to say about that. They really don't. I thought there was more to say about it in here. So usually the state income taxes, as the book mentioned, state income taxes should be withheld based on where the services are performed, unless there is a reciprocal agreement between the states. So if there's no such agreement, the employee works in one state and lives in another, the laws of both states must be considered. There are 3 different methods of withholding. Mentioned here. Full taxation means it's going to be taxed in both the resident state and the work state, and you'll calculate the tax without regard to any credits. Leftover taxation, pay the full tax to the work state, and then pay the rest to the resident state, if there is any additional. And then a reciprocity would be the third option. Withhold only for the work state or resident state, depending upon the reciprocal agreement between the states. So that would, the reciprocal agreement would, you'd have to reference whatever that reciprocal agreement is to withhold based upon that. Let's see. So it's entirely possible, of course, that somebody who's working in payroll is going to have to be familiar not only with the state that they're working in, and not only the locality that they're working in, but also other states. Certainly if you've got employees working in multiple states. Okay. That's really all I wanted to say about that. All right. So let's review, or